We see a change in sentiment now. Initially, G20 leaders helped to spur some positive risk sentiment in the markets, but of course that's all turned around. Why do you think?
Well, I think it really is a case of it's good to hear those sort of talk being talking, but we really do need to see the action as well. And I think investors are getting a little bit punch drunk and weary from politicians promising things but not really being able to deliver on those promises. And I think they really need to see now some action and see the positive implications and benefit of some of the measures that politicians and the likes of Federal Reserve Bank governors and so on that they bring to the party, that actually translates to anything of substance on the ground. Because I think despite so many different types of measures over the last weeks and months, we still do not really see any significant benefit flowing through either into the economy or certainly then into the equity and bond markets on a sustainable basis.
This brings into question how much power reserve banks have to really stimulate economic growth, because of course we had the FOMC meeting this week. Ben Bernanke saying that they're going to be selling on the short end to buy at the long end of the curve. And then we had our local rates decision yesterday where we kept rates on hold. But many are questioning really the power that reserve banks have to stimulate growth.
Of course, they do have the power, but whether that power is effective, I think, is what is being called into question. We see so many different approaches being taken by the different central banks around the world, and it's almost as though many of them are focusing on only one or two measures rather than a coordinated effort within a particular region. So if we look at the US, for example, certainly up until now, it's been mostly monetary policy that was driving it with exceptionally low interest rates. Ben Bernanke was quite clear a couple of weeks ago that there will not be a QE3, but of course we did realize that he had to continue supporting the market in some way, so his intervention in the yield curve this past week was not a surprise, but I think the fact that it was not nearly as effective as he would have liked to see it just shows that even on the monetary side these have not really been effective measures. And Europe have taken a very different stance. They've taken a much more a stance of let's do fiscal austerity, let's try and reduce the debt load and so on, and all that has really resulted in is a continual debt spiral, because the economic growth is declined to such an extent that they're just not getting the enough inflows to actually balance the books.
But of course we do have tax hikes which are being proposed in the United States, specifically targeted at the rich, but I suppose it's between getting the right balance of a hike there, because you don't want to take too much money out of the system.
Absolutely. You know, Nouriel Roubini this past week certainly also cautioned against this in particular, where he was saying that one of the biggest dangers in a financial crisis like that is that you almost over-regulate the market, and that you actually kill off the little bit of potential that is still left in the system. And for us, tax increases falls very much into this sort of category, because all it really does is to take more money out of the system where it could potentially be used to stimulate growth, to create jobs and so on, and it puts it into the coffers of the fiscus, where we know that government is certainly not the most efficient way of creating jobs, of stimulating growth in the economy and so on. Government should really just be playing the enabling role, creating the environment for business and the private sector in which it can be this instrument in the economy. But it's as though worldwide we have politicians that have a distinct lack of leadership other than worrying about their next election, and we just don't see the decisive moves that are needed to actually pull the world out of this very dire position that we find ourselves in.
And we're in a very dire position back here in South Africa. Just listening to Jill Marcus's speech yesterday, really concerned around Q3 and second half of the year growth numbers that we might see, given the fact that primary and secondary growth in the second quarter declined, tertiary economy only posted marginal growth there. What for you was the biggest takeout from her comments yesterday?
I think it really just shows that South Africa is on the receiving end here of a lot of what happens in the world. We do live in a global village, and it's really just a case of there's so much that is being imposed upon us from an exogenous point of view that once again it doesn't really leave all that much room for the monetary policy per se to actually stimulate the growth that is needed. So our own Reserve Bank, very much like many other reserve banks around the world, find themselves caught between the rock and the hard place that is called declining economic economic growth and rising inflation. And if monetary policy is the only measure that you try to use, the only blunt instrument to try and get yourself out of this situation, it is not going to work. So yes, certainly South Africa is along with the rest of the world, caught up in this debt spiral. And I believe that one really needs to focus a lot more on where you can actually make a difference, rather than trying to manage the exogenous factors that we have no control over. And certainly I think the rand is a great example of that. It is something over which we do not have any control, and we should rather focus on aspects that we do have control over.
We've seen foreigners being net sellers of our bonds, and that's really why the rand has weakened so significantly. Marcus thinks this might be short-lived. Would you agree?
Not necessarily short-lived. I think we might have found a bit of a new level in terms of the rand, but it's certainly on the back of the foreigners that have sold not only our bonds but also on the equity market. You know, we've seen over 16 billion rand flow out of our equity markets year to date, and almost half of that was done just in September. Until the end of August, the inflows into our bond market was a spectacular 45 billion rand. More than 9 of that has reversed again during September. So this definitely is an indication of the foreigners using this highly liquid emerging market currency called the rand to actually liquidate positions and raise the cash that they need to repatriate and actually manage their own positions back home. I find it interesting that when you look at, for example, the Brazilian central bank, they intervened into the real just this last week to the tune of $2.75 billion, because their own currency have also weakened by 17%. So South Africa is not unique in this situation, but obviously we focus on what affects us most.
Nerina, very quickly, very few pockets of green on the local bourse here in South Africa, but SAB Miller seems to be riding on the positive sentiment around the deal with Foster's. What do you make of that, a final conclusion of that deal?
I think it's a combination of a very good deal and one that is good for SAB Miller, but it also highlights where the pockets of value in our market is still to be found. Given the uncertainties in the scenario that we've seen, certainly out of favor is all your cyclical stocks. One would think that the rand hedges would be great, but if you were going to look for these within the commodity space, that's not the place. It's really in your industrial rand hedges, the non-commodity rand hedges, and of course SAB falls straight into that camp. So SAB, a great deal for them. They've been at the forefront of development into the emerging markets where they go for the premium brands, Foster's being their biggest deal to date, and the market liked it, and it's certainly giving them the thumbs up.